Welcome everyone to this webinar. I am Simonne Paumard, Mortgage Loan Officer with Pacific Wholesale Mortgage. And today the goal here is to educate people who have a bad credit score and want to get a mortgage, but don't know if they should apply because their score is so low. I came across people who went through bankruptcy 2 years ago, and they already have a 700 credit score because their bankruptcy attorney took a few minutes to educate them on how FICO scores them. And when you understand the game, all you have to do is play by the rules, and your score will go up. But a few people understand what FICO is looking at and how they weight at different aspects of your credit. The purpose of this presentation is to educate you how to fix your credit for free without hiring anybody. There are some situations, though, where people have a lot of derogatory accounts, a lot of collections. So in those situations, asking for some help from companies is entirely appropriate. But for other people having late payments, high balances, lots of credit cards is the real reason behind why your score is so low. Hence, changing how you do with active lines of credit can go a really long way. So now, let's dive into the presentation. I talked about what is FICO score. FICO is a company used to be called the Fair Isaac Company, and a few years ago they made FICO the official name of the company. It's not a reporting agency. FICO has all the theories that report agencies use to come up with scores. There are 3 different reporting agencies: Equifax, TransUnion, Experian. Those are the 3 agencies will create the scores. So let's go into these scores. Let's understand where those scores are coming from. So the biggest majority of your credit score is coming from your payment history. And that's why when you're like 30 days late, your score drops 60 points. Now, the second closest to that is the amount of debt you owe on cards. So number 1, make sure you make your payments on time. Number 2 is the percent usage on your credit cards. Number 3 is the age of your credit history. In the mortgage industry, they like to see at least 6 months of credit history before you're going to show up with a credit score. So for me, when I have someone who wants to apply for a loan and they don't have a credit history, it's an issue because they will have a special type of loan, but with higher risk. It's almost as bad as if you had bad credit, because a lender has no idea how to establish your attitude towards to paying off your debt. Next in line is a new credit inquiries that can drop your credit as much as 10%. And then lastly, they like to see different kind of loans like a car loan, installment debt, revolving debt. FICO likes to see a bit of mix between all of those lines of credit. That being said, now I want to go over what is not in the FICO score. So you won't find your race, color, origins, national origin, sex, marital status, your age, your salary, occupation or title, who is your employer or the date employed or employment history, and where you live. FICO won't show any interest rate being charged on a particular credit card or other account. And any items reported as child or family support obligations. But any items like this, unless you are in the arrears in your child support, and it's tough and gets to a lot of people, because when you go to court, it can take up to 4 to 5 months for the judge to rule whether or not you owe child support. And sometimes they will hit you with some amount of real payments. And so your scores go down. So for people in divorce proceedings, it's worth to watch out not to fall in this category. And FICO is not interested in whether or not you're participating in a credit counseling of any kind either. Now, what is a good FICO score? You need to know that every industry uses its scoring matrix. It doesn't mean that the score your auto loan pulled will be the same one as what a loan officer will pull. You'll get 3 different scores each time. The mortgage loan will be the biggest one in your life. So the scores we are going to see on our side of the fence will be a little lower than what you are going to see on the Credit Karma, because we are weighing things little differently. Sometimes it will be close. So each of those companies, TransUnion, Equifax, Experian, they will have different scores. If you get only 2 scores from those companies, we still can originate a loan. But if you get only 1, it's going to be a higher risk for a lender. If I have multiple borrowers on the same loan application, I have to take the lowest borrower middle score. The higher risk borrower always drives the file when you're trying to get a mortgage. So keep in mind, we are not averaging your scores. We take the lowest middle score of all. Now, government-backed loans, whether it is a VA, USDA, or FHA, because we are in the state of California, I have to pull the spouse credit as well, if you're legally married. Even if you're separated, but still technically you're legally married, it can pose a problem. So if it's the case, we try to stay away from those government-backed loans and consider conventional loans where I don't have to do that. So back to the scores range. To get the best rate in the mortgage industry, you want to be over the 740 to 760 marker. That's where you get top tier pricing and terms. Whether your score drops under 7, whenever your score drops under 700, conventional loans start to get a little more choosy as to whether or not they want to take the clients. 600 to 649 is not a great territory to be. So we are going to start to look at more specialized lenders. Again, I'm a broker, so I get a lot of different banks, and some are specialized in 600 to 650 range borrowers. They do that all day long. They are not the fastest lender out there, but they get the job done. Anything below 600 is considered poor and not so great. We are going to want to completely change the type of loan to make the deal work. For the people below 500, the only way to establish better credit is to get some credit and show FICO you are doing good with that credit. So what I encourage you to do here is to get a secured line of credit where you go to a bank of your choice, Wells Fargo, Bank of America, whichever, give them $500 to get a credit card. Here you are borrowing against your own money. And you start to buy stuff with this card, never over the amount of 500, of course, repay it each month. And this will show you are responsible for your debt. So again, here you need to ask for a secured line of credit to the bank. Paying off debt is good, but the account shouldn't stay at 0 credits. Eventually, FICO will stop scoring you because they won't have any reason to give you a score. So the idea behind credit repair is not necessarily to pay off everything, but actually to strategize to establish more active good lines of credit than you have bad active lines of credit. You know what bad is, So the good lines of credit are the ones where you make your payments on time, and the maximum balance to usage ratio needs to be below 30%. Even better would be 25%. For example, if I have a credit card with Best Buy and Best Buy gives me a $1,000 limit on the credit card, I never want my balance to be more than $250. It's 25% of $1,000. So as long as my balance is under $250, I am in the green zone with that card. So what is happening? Every time my card reports to FICO, my score is going up. FICO can learn more on your credit card than on your installment or mortgage loan. It shows how you deal with your debt. So when you want to repair credit, use this strategy. Do not pay off your card to zero, but reduce the balance amount to 25% of the total line of credit on the card, and make your payments on time. For collections, they are recent, as inactively reporting, meaning they are still coming after you, not like, for example, AT&T stopped and gave up 5 years ago, and this is an old one, not active anymore. But if they are still coming after you, then you pay them off. Your score's gonna turn. If you pay off an old one, this old line of AT&T you had 5 years ago and they were not reporting anymore, if you pay that off, your scores are gonna go down a little bit in the short term. And in the short term, it brings a blemish to your score because you bring back an old line on the front line. So pay attention. When was the last time the collection was reported? And if they are still coming after you, take care of them, try to pay them off. Remember, they are just strings. Cut those strings, you will do better with the other active lines. But if someone comes to me with only collection debt, I tell them to go and take immediately 2 or 3 secured credit cards and start to build their image with FICO, so FICO will bring you up. Never be late in your payments. Set up bill payment reminders. One payment late can undo months and months of progress. In case of bankruptcy, go to your bankruptcy attorney to recover faster with a few changes in your debt and in your behavior. Do not open many credit lines at the same time. It makes FICO very nervous. Closing a good account hurts your credit. Never close an account. It's going to hurt you. FICO wants to see them. You can shred your credit cards or not use them, but don't close them. It's the opposite effect on credit repair. So how long does bad credit stay on my credit report? A general rule is that for all credit, it will stay 7 years. Exception to this rule is bankruptcy chapter 7. Chapter 7 is the worst type where you knock off everything, and it will remain on credit for 10 years. While chapter 13 is when you start to repay a portion of that debt back during the bankruptcy proceedings. Chapter 13 will stay on for 7 years. Judgments and tax liens, if unpaid, can stay on credit indefinitely. But once it is showing satisfied, it will come off after 7 years of being paid. Those are a great deal in the mortgage industry. Now is my favorite slide, explaining the 4 basic loans types. Like the conventional loans are great. Everybody wants them. That conventional loan is the pickiest one. They want good credit, essentially, but not everyone has good credit. So if you have a credit score less than 740, 760, conventional loan will give you higher interest rate and higher mortgage insurance in the case you have one, And this applies when you put less than 20% down payment. Jumbo loan is even more conservative than conventional. It requires higher credit score because it's a bigger loan size. Government-backed loans are taking people who have lower credit scores and still offer you an even better rate. We consider FHA loans if someone has a challenged credit score. The VA loan is, in my opinion, the strongest loan out there because there is no money down, no mortgage insurance. They get an amazing rate besides from the funding fee. The VA loan is something I would always encourage people to do if they are or have been, of course, in the military. But in general, with government-backed loans, if your credit score is 680 or higher, you're going to get cream of the cream top rates. Rates are always going to be lower on a government-backed loan because the loan is backed by the government. If you default on a VA loan, guess who is going to come after you? The government. So that's why there is less risk for me as a lender, and I can give lower rates. Remember, all pricing is risk-based. Down payment assistance programs, they require that you are over 660. Definition of Fannie Mae and Freddie Mac regarding the derogatory credit is that the presence of significant derogatory credit events dramatically increase the likelihood of future defaults and represent a significant higher risk, level as a default risk. So, examples of events that will affect your capacity of getting a mortgage are listed here. They are the case of bankruptcy, foreclosures, short sales, deeds in lieu of foreclosures, collection accounts, judgment, and liens. There are waiting periods associated with each of those events before you are eligible to get a mortgage. So on the columns, you have the derogatory events: foreclosure, short sale, chapter 7, chapter 13. And on the left side rows, you have the types of loans and the waiting periods associated with each event. Fannie Mae and Freddie Mac are basically the conventional loans. As you can see here, the government-backed loans, again, make it easier to get. If you want, I can send you this chart for your records, just ask. So let's talk about judgment and liens. If a creditor obtains a judgment against you in court, that judgment could possibly attach to your home or other property as a non-consensual lien. They don't need your agreement for that. And the lien is the right to keep possession of property belonging to another person until a debt owed by that person is discharged. So for me as a lender, it's a problem when I am financing your house and the government can come and take that away because you owe them money too. Open judgments and liens that appear in the public section of the credit report will be identified by an underwriter. So those judgments and liens will have to be paid off before closing. You cannot have outstanding judgments and liens on your credit report and get a mortgage. Collections accounts refer to a loan or a debt the creditor gave up and they turn over to a collection agency, and that collection agency is coming after you. Collections are less serious than a judgment or a lien. If you owe $500 to AT&T, it's less serious than if you owe them to the IRS. Same with a school loan. Oh gosh, school loan. If you default on a school loan, the level of severity is 10 times higher than if you owe to Verizon, for example. Collection accounts, you still can get a mortgage. But if the collective balance of all the accounts exceed $2,000, then there are some criteria we need to meet. You will have to pay it off. You have to show some arrangements made for payments to the creditor, how much they charge to take this care of, or we have to hit you with 5% of the outstanding balance on each collection on monthly payment. So how does it affect you? You get a smaller loan. I'm adding a bunch of debt to your debt to income ratio. So now, instead of a loan of $400,000, it will be $350,000. And that's the penalty that Fannie Mae and Freddie Mac come up with to allow folks to still be able to get a mortgage. More often, collection accounts that people have, they don't know about, are medical in nature. Most of the time, depending on your PPO or HMO health insurance, there is a miscommunication somewhere. And in fact, medical collections are another category. And so for charge-offs, they don't have to be included. They do not affect anything. Compensating factors are a reason for the lender to justify bringing on higher risk borrower. Whenever the compensating factors gets to be on the lowest side of things, the lender is going to require that what we call compensating factors. Ultimately, your debt to income ratio, the DTI, is going to be stretched up to certain thresholds. But once they have got to be higher than a certain threshold, now we need even more compensating factors. So let's see what some of them are out there to get a loose understanding of this kind of stuff. So the first compensating factor is if you have money left over that you're not using all of it in your bank account to buy a house, it's great and it looks really good. We look at something called reserves, equal mortgage. If you have 6 months reserves, that means you have 6 months mortgage payments sitting somewhere in a 401k or another bank account. It's great. The next compensating factor is if your current housing payment is pretty much the same as the one that is going to be, meaning there is a minimal change like $100 difference or 5%, whichever is less. For that to be a compensating factor, we need to document that there has been monthly housing payments for 12 months and no more than one 30-day late payment if there is one. Discretionary debt, they may be cited as a compensating factor subject to some requirements. No discretionary debt, there are not a lot of people falling under this criteria. It's never considered a compensating factor. It is the concept of, I have 3 to 4 credit cards. I used to pay them off each month, so I never had a rolling balance on them. That looks good for FICO, but it's complicated because you have to prove that you have been putting balances on the credit card since you've paid them off. Your balances show 0, so your credit report will show 0. And let's say for the past year. So that's not a compensating factor. And the last one I want to talk about is having a substantial income that I cannot use. For example, income from overtime. You have got to have 2 years history of overtime for me to be able to consider it. But if I see you've got a solid 1 year, I can use that to justify taking on higher risk borrower. So if it's going to continue also, we'll consider taking the debt to income ratio, the DTI, down and consider this person for a loan. So in conclusion, we talked about what is FICO, how our scores developed, and the main purpose of this presentation is how to repair existing credit scores. How long does bad credit stay on the credit report, and the effects on the regulatory credit, different types of mortgage. So I hope that this presentation brought some light and knowledge on how to do repair for your credits. And if you have more questions or to talk about it, I'm always happy to help. Reach out to me. The phone number is 858-353-3408. Thank you for attending this presentation.